An ETF is a fund that tracks an index or group of indices. It is a passive investment vehicle that can be bought and sold like a stock. It is a great way to invest in a basket of stocks without having to research each individual stock. A mutual fund, on the other hand, is a more active investment vehicle. You are expected to research the individual stocks within the mutual fund and decide whether or not you want to buy them. There are many different types of ETFs available, and they all have their own unique characteristics and pros and cons. Here we will look at what is an exchange-traded fund. Before, please like and share the video, subscribe to this channel and click the bell icon for more updates. Understanding exchange-traded funds. An ETF is called an exchange-traded fund because it's traded on an exchange just like stocks are. The price of an ETF's shares will change throughout the trading day as the shares are bought and sold on the market. This is unlike mutual funds, which are not traded on an exchange, and which trade only once per day after the markets close. Additionally, ETFs tend to be more cost-effective and more liquid compared to mutual funds. An ETF is a type of fund that holds multiple underlying assets, rather than only one like a stock does. Because there are multiple assets within an ETF, they can be a popular choice for diversification. ETFs can thus contain many types of investments, including stocks, commodities, bonds, or a mixture of investment types. An ETF can own hundreds or thousands of stocks across various industries, or it could be isolated to one particular industry or sector. Some funds focus on only US offerings, while others have a global outlook. For example, banking-focused ETFs would contain stocks of various banks across the industry. An ETF is a marketable security, meaning it has a share price that allows it to be easily bought and sold on exchanges throughout the day, and it can be sold short. In the United States, most ETFs are set up as open-ended funds and are subject to the Investment Company Act of 1940 except where subsequent rules have modified their regulatory requirements. Open-end funds do not limit the number of investors involved in the product. Types of ETFs. Various types of ETFs are available to investors that can be used for income generation, speculation, and price increases, and to hedge or partly offset risk in an investor's portfolio. Number 1. Passive and active ETFs. ETFs are generally characterized as either passive or actively managed. Passive ETFs aim to replicate the performance of a broader index, either a diversified index such as the S&P 500 or a more specific targeted sector or trend. An example of the latter category is gold mining stocks. As of February 18, 2022, there are approximately 8 ETFs that focus on companies engaged in gold mining, excluding inverse, leveraged, and funds with low assets under management. Actively managed ETFs typically do not target an index of securities, but rather have portfolio managers making decisions about which securities to include in the portfolio. These funds have benefits over passive ETFs but tend to be more expensive to investors. Number 2. Bond ETFs. Bond ETFs are used to provide regular income to investors. Their income distribution depends on the performance of underlying bonds. They might include government bonds, corporate bonds, and state and local bonds called municipal bonds. Unlike their underlying instruments, bond ETFs do not have a maturity date. They generally trade at a premium or discount from the actual bond price. Number 3. Stock ETFs. Stock ETFs comprise a basket of stocks to track a single industry or sector. For example, a stock ETF might track automotive or foreign stocks. The aim is to provide diversified exposure to a single industry, one that includes high performers and new entrants with potential for growth. Unlike stock mutual funds, stock ETFs have lower fees and do not involve actual ownership of securities. Number 4. Industry or sector ETFs. Industry or sector ETFs are funds that focus on a specific sector or industry. For example, an energy sector ETF will include companies operating in that sector. The idea behind industry ETFs is to gain exposure to the upside of that industry by tracking the performance of companies operating in that sector. One example is the technology sector, which has witnessed an influx of funds in recent years. At the same time, the downside of volatile stock performance is also curtailed in an ETF because they do not involve direct ownership of securities. Industry ETFs are also used to rotate in and out of sectors during economic cycles. Number 5. Commodity ETFs. As their name indicates, commodity ETFs invest in commodities, including crude oil or gold. Commodity ETFs provide several benefits. First, they diversify a portfolio, making it easier to hedge downturns. For example, commodity ETFs can provide a cushion during a slump in the stock market. Second, holding shares in a commodity ETF is cheaper than physical possession of the commodity. This is because the former does not involve insurance and storage costs. Please don't wait to ask in your comments section if you have any other queries. Thanks for watching. See you in the next video. Please like and share the video, subscribe to this channel, and click the bell icon for more updates.